Questions ordered.
Mr. President, I think, as most Americans understand, as a result of the greed, the recklessness, the illegal behavior of a relatively small number of financial institutions, the United States of America is currently in the midst of the worst economic and financial crisis since the Great Depression. Millions of Americans have lost their jobs. Millions of other Americans are working longer hours for lower wages. People have lost their homes. People have lost their savings. And people have lost, in many respects, their hope. On Friday, we learned that the official unemployment rate is now 10.2%, the highest in over 26 years. But the official unemployment rate really tells only half the story. If you add up the number of people who are underemployed, if you add up the number of people who have given up looking for work, what you find is that we have 27 million people in that category of unemployed or underemployed, which is 17.5% of the American workforce. 17.5%. That is an astronomical number. And obviously there are areas of our country in the Midwest and in California where the number is substantially higher than that. Mr. President, over a year has come and gone since Congress passed the $700 billion bailout of Wall Street. In addition, of course, the Federal Reserve has committed trillions of dollars in zero-interest loans and other assistance to large financial institutions. Added together, this amounts to the largest taxpayer bailout in the history of the world. President Bush, former Treasury Secretary Paulson, and Fed Chairman Ben Bernanke told us that we needed to bail out Wall Street because we could not allow huge financial institutions and insurance giants to fail. And what they said is that if any of these large institutions failed, they would lead to systemic damage to the financial system and, in fact, the entire economy. Now, one might think if these institutions then were too big to fail, that, it doesn't take a PhD in economics to figure out that maybe one of the important solutions would be to make them smaller. Too big to fail? Well, let's reduce their size. Yet, in the last several years, these financial institutions, in many respects, did not get smaller, but amazingly enough, they got larger. Too big to fail? What do? Make them larger. Now, that may make sense to somebody. It doesn't actually make sense to me, nor do I think to a majority of Americans. Last year, Mr. President, the Bank of America, the largest commercial bank in this country, which received a $45 billion taxpayer bailout, purchased countrywide the largest mortgage lender in this country, and Merrill Lynch, the largest brokerage firm in the country. So you had a huge bank, too big to fail. They became larger through the consolidation of Countrywide and Merrill Lynch by the Bank of America. Last year, J.P. Morgan Chase, which received a $25 billion bailout from the Treasury Department and a $29 billion bridge loan from the Federal Reserve, acquired Bear Stearns and Washington Mutual, the largest savings and loan in the country. Too big to fail? Well, what happens if you are J.P. Morgan Chase? You become bigger. Last year, the Treasury Department provided an $18 billion tax break to Wells Fargo to purchase Wachovia, allowing that bank to control 11% of all bank deposits in this country. Too big to fail? If you're Wells Fargo, make it bigger. Today, Mr. President, these huge financial institutions have become so big that the issue now is not just too big to fail and taxpayer liability. The issue becomes concentration of ownership. According to the Washington Post, the four largest banks in the United States, that's the Bank of America, Wells Fargo, J.P. Morgan Chase, and Citigroup, now issue 1 out of every 2 mortgages. Half of the mortgages in America are issued by 4 large financial institutions. 2 out of every 3 credit cards in this country are issued by the 4 largest financial institutions in the country, and these same institutions hold $4 out of every $10 in bank deposits in the entire country. So what we're looking at here is not just taxpayer liability for when huge financial institutions collapse and the taxpayers have to bail them out. Now what we're also looking at is concentration of ownership, where a handful, 4 major financial institutions, control half of the mortgages, 2 out of 3 credit cards, and 40% in bank deposits in the entire country. That is wrong from a competitive point of view, from a point of view that the consumer has to have some choices and has to see some competition in order to get a break. The face value of over-the-counter derivatives at commercial banks has grown to $290 trillion. That is an astronomical sum of money, 95% of which are held at just 5 financial institutions in the entire country. 5 financial institutions control 95% of over-the-counter derivatives. Mr. President, derivatives are nothing more than side bets by Wall Street gamblers that oil prices will go up or down, or that the subprime mortgage market will continue to get worse, or betting on the weather, or whatever else can make them a quick buck. Risky derivative schemes led to the $182 billion bailout of AIG, the collapse of Lehman Brothers, the downfall of Bear Stearns, and precipitated the largest bailout in the history of the world and the severe recession that millions and millions of people are experiencing today through their loss of jobs. Mr. President, if any of these financial institutions were to get into major trouble again, taxpayers one more time would be on the hook for another substantial bailout. And in fact, the next time it might even be bigger than what we saw last year. Now is the time to say clearly that we cannot allow that to happen. Not only are too-big-to-fail financial institutions bad for taxpayers, the enormous concentration of ownership in the financial sector has led to higher bank fees. Every member of the United States Senate has heard from constituents who pay their credit card bills on time every single month. They have then bailed out Wall Street, and what they get in return is interest rates which have gone from 10 or 15% to 25 or 30%, and that is what you get when 4 large financial institutions control 2/3 of the credit cards in this country. According to Business Week, and I quote, Bank of America sent letters notifying some responsible cardholders that it would more than double their rates to as high as 28%. And that's what we're seeing all over this country. Today, credit card interest rates went up by an average of 20% in the first 6 months of this year, even as banks' cost of lending declined. And we all know this. So here are these guys on Wall Street. We bail them out. They become bigger. And they say, thank you, America. Now we're going to raise the interest rates on your credit cards to usurious rates. Outrageous. Unacceptable. 25 or 30% interest rates on hardworking people who pay their bills on time should be something that should be eliminated. And in fact, on another issue, we have legislation to do just that. Mr. President, it seems to me that if you add all of that together, the fact that the largest banks that were too big to fail have grown larger, that we have a very dangerous concentration of ownership within the financial institution industry, the time is now to do exactly what good Republicans like Teddy Roosevelt and William Howard Taft did 100 years ago, and that is to start breaking these institutions up. That's what we've got to do. We've got to start breaking these institutions up. And last week I introduced S-2746, the Too Big to Fail, Too Big to Exist Act, that would do just that. And I think the title of that legislation that I've introduced says it all. If an institution is too big to fail, It's too big to exist. Let's break it up. Now, this legislation is all of 2 pages long. It's not 2,000 pages like the health care bill. It is 2 pages. That's all it is. Very simple. And this legislation would require the Secretary of Treasury to identify every single financial institution and insurance company in this country that is too big to fail within 90 days. That shouldn't be too hard to do. Who are the institutions that are too big to fail? Tell us who they are. And then within the rest of the year, within 1 year, start the process of breaking them up. Mr. President, one of the reasons that a further reason that we have got to break these institutions up is not just that they continue to be a liability for taxpayers, not only that the concentration of ownership leads to higher and higher interest rates, leads to the fact that Wall Street remains an entity unto itself, largely a gambling casino, which makes huge amounts of money for the people on Wall Street, but ignores the credit needs of small and large businesses in the productive economy. But there is another reason. And the other reason is that I know some of my friends here say, well, you know, we've got to regulate Wall Street. That's what we really have to do. Don't break them up, regulate them. But let me tell you something. It is not the Congress that is going to regulate Wall Street. It is Wall Street that is going to regulate the United States Congress. And I think anybody who knows anything about politics knows that that is true. We know that over a 10-year period, Wall Street has spent $5 billion on lobbying and campaign contributions, and despite their greed and the fiasco which they caused, what they are doing now is spending millions more trying to make sure that Congress allows them to go back to where they were. So I don't think it's a question of us regulating them. It's them regulating us, and with so much wealth and so much power, that is what they are capable of doing. Mr. President, what we are beginning to see, not only in the United States, but all over the world, are people saying enough is enough. And I find it interesting that John S. Reed, who helped engineer the merger that created Citigroup Incorporated, apologized for his role in building a company that has taken $45 billion in direct U.S. aid, and said banks that big should be divided into separate parts. And that is what John S. Reed said, the former CEO of Citigroup. He is one of the people who engineered the deregulation effort, and he has apologized to the American people, and I respect that very much. One of the few who has had the guts to come before the United States and say, yeah, I made a mistake, I am sorry. And I respect him doing that. Furthermore, we have Alan Greenspan, who probably more than any other person in this country led the effort to deregulate, to do away with Glass-Steagall. Had this philosophy that said if we deregulate, if we allow these titans on Wall Street to do anything they want, my goodness, they're going to create wealth for the whole economy. But even Alan Greenspan, whose disastrous leadership helped lead us to where we are right now, even he, I think, has recognized the error of his ways. According to Bloomberg News on October 15, 2009, former Chairman Greenspan said, quote, "If they are too big to fail, they are too big." In 1911, we broke up Standard Oil, so what happened? The individual parts became more valuable than the whole, end of quote. That is Alan Greenspan understanding the errors that he made. Now, I should note, Mr. President, and I am grateful that Mr. Greenspan's views on this subject have drastically changed, because when I was in the House on the Financial Institutions Committee, and he would come before that committee, he and I used to have a little bit of a debate on the issue of deregulation. And I remember back in 2000, I asked Mr. Greenspan the following question. This is what I asked him. Quote, Aren't you concerned with such a growing concentration of wealth that if one of these huge institutions fails, that it will have a horrendous impact on the national and global economy? End of quote. That was my question. And here is what Mr. Greenspan said in the year 2000. Quote, "No, I'm not. I believe that in the general growth in large institutions have occurred in the context of an underlying structure of markets in which many of the larger risks are dramatically, I should say fully, hedged." End of quote. Well, unfortunately, Mr. Greenspan appeared to be wrong, was wrong, and we have spent $700 billion bailing out Wall Street and trillions more on low-interest loans. But it is not just Alan Greenspan who has changed his views. According to the Washington Post, and we know this to be the case, quote, "The British government will break up parts of major financial institutions bailed out by taxpayers. Spurred on by European regulators, the British government is forcing the Royal Bank of Scotland, Lloyds Banking Group, and Northern Rock to sell off parts of their operations. The Europeans are calling for more and smaller banks to increase competition and eliminate the threat posed by banks so large that they must be rescued by taxpayers no matter how they conducted their business in order to avoid damaging the global financial system." In other words, what the United Kingdom is beginning to say, we've got to start breaking up these institutions. If they're too big to fail, they're too big to exist. But it's not just Alan Greenspan. It is not just John Reed, the former CEO of Citigroup. It is Paul Volcker, the former Federal Reserve Chairman and the head of President Obama's Economic Recovery Advisory Board. And this is what Paul Volcker has said, and I quote, "Keep banks small so that any failure won't have systematic importance." And then he continues, "People say I'm old-fashioned, the banks can no longer be separated from non-bank activity. That argument brought us to where we are today." End of quote, Paul Volcker. Robert Reich, President Clinton's former labor secretary, has said that, quote, "No important public interest is served by allowing giant banks to grow too big to fail. Wall Street giants should be split up and soon." End of quote. That's Robert Reich. Sheila Bair, the head of the FDIC, has said that, quote, "We need to reduce our reliance on large financial institutions and put an end to the idea that certain banks are too big to fail." Simon Johnson, the former chief economist of the International Monetary Fund, the IMF, has said, and I quote, "Banks that are too big to fail must now be considered too big to exist." End of quote. Now, Mr. President, I am under no illusions that taking on Wall Street will be an easy task. Generally speaking, Congress is never successful, or very rarely successful, taking on big money interests. They are just too powerful. They have too much sway over this institution. As I mentioned earlier, incredible. I mean, this is just quite incredible. The banking and insurance industries have spent over $5 billion on campaign contributions and lobbying activities over the past decade in support of deregulation, and they are spending even more today to try to prevent Congress from seriously regulating their industries. In 2007 alone, and if people want to know why the rich get richer and everybody else gets poorer, they should understand that the financial sector employed nearly 3,000 separate lobbyists to influence federal policymaking. Remember, we only have 100 people in the Senate, 435 in the House. They got 3,000 separate lobbyists. So if anyone thinks that it's going to be easy to reform the financial services sector, it clearly will not. But if we are going to turn this economy about, if we are going to try to prevent another disaster by which taxpayers have to bail out some of the wealthiest and most powerful people, if we are going to create a situation where financial institutions provide capital to the productive economy so that we can create decent-paying jobs producing real products and real services, we are going to have to finally stand up to these very, very powerful institutions. So, Mr. President, I think the issue is clear. I think all over this country, people, whether they're progressive, whether they're conservative, understand that if an institution is too big to fail, it's too big to exist. Let's break them up. Thank you, Mr. President. I yield the floor.